Okay, so this is the Amex income statement. You know, as a financial company, they're pretty unusual. So, trying to get a sense for they have non-interest revenues. And then they have interest-bearing revenue, which goes with interest rates, so it's gone up a lot. And so that's sort of total revenue. We'll come up with that ourselves. Remember, this was a Buffett darling for a long time as well. Okay. And then there's interest expense. So, okay, so was this what I had before? Larry, that better not be the money out of my goddamn purse. Oh, baby, I'm sorry. I love that she knows where to look for him at the dice game. Where else would he be? Okay, so this is their weird revenue. So you build it up through interest, non-interest income, interest, and then subtract interest expense, and then you get revenue, which is like, what? So what are their costs? Well, card member rewards. So these are Amex rewards. That's the expense. They don't spend too much on these rewards relative to the income they get. It's a pretty sick business. 61 billion of revenue, 17 billion in rewards. I'm most bearish on probably D-Wave, but also IonQ and Rigetti. They're all good shorts. They just have slightly different like looks and feels to them. Yeah, I don't understand. What are some of these rewards? Yeah, there's defaults here. They have all the data. Okay. So business development. I don't know what business development is. It means different things to different people. Card member, services, marketing, salaries. These all seem to be the same cost. And then other. Okay, let's see here. 6041, 60, 807, 63, 64. I'm getting a Thinkorswim Charles Schwab account, so I'm excited. Let's see what their brokerage is up to. See if they have better borrow rates and stuff like that, and better software. See what their API is like. Did anyone use their API? Yeah, good opportunity if you got the capital. D-Wave 2. IonQ is hard to borrow on Interactive, so you can't even short it if you want it. Oh, okay, Jesus. Okay, so this build out sort of makes sense to me. Looks like they've been doing pretty aggressive buybacks too, so earnings have gone up quite a bit, but I wonder how much of that is due to interest rates going on. All right, skip the balance sheet for a second, go to see how cash flow looks. So cash flow was 21 billion. Cash flow's actually gone down as their interest rates have gone up, ironically. I wonder why. That's so weird. They don't really have any CapEx. So free cash flow the last 3 years averaged 16 billion. Oh, this could be cheap. Well, you should have if you have a lot of money, you should have a brokerage. You should have a brokerage open with every brokerage, basically, if you're a pretty serious investor. There's nothing wrong with having just one main one that you use. But if you're really a big shot, you need one everywhere. You're constantly shipping money to and fro, or your staff is doing that for you. Yeah, I would split your money across all the brokerages. The only reason you wouldn't want to do that is qualifying for margin and stuff like that in each brokerage. It's different levels of different margin and different levels of different products that you can or can't use. Is now the time to short D-Wave and IonQ? Hell yes. The only question is how big. Brokers make money all kinds of ways, but typically they make money on your balances, earning interest, and then giving out margin loans, and then transaction fees. 3 or 4 different ways. Okay. Don't worry, quantum will sell off. Just stay liquid. Really simple balance sheet for Amex. Top 5 quantum chip companies. Dylon, 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 and Dylon. I actually haven't tried Alpaca. I really do want to try it. Yeah, investing from the retail perspective is maybe gamified, but hadn't changed professionally. The interest rates for shorting stocks are not too bad. I mean, they're quoted annually. So if you have a 5% interest rate, let's say, or 12% borrow rate, you're basically paying 1% a month, which if you think the stock's going to go down 50%, 1% isn't much to pay. If you're paying 100% borrow rate, well, I would try to get a lower borrow rate. But, you'd be paying 8% a month in that case. But daily, it's not very much. Even the highest borrow ever, the daily is pretty modest. Yeah, amazingly simple balance sheet here. Yeah, daily, 100% daily, nobody could handle that. That'd be insane. You'd have to basically be sure at 100% daily, you couldn't get a return even if it dropped 100%, right? So if it's 10% or something, yeah, daily, I mean, it would not be tenable. There'd be no way to do it. And it is a market like any other market. So somebody can say, I will lend you my stock out for 3,000%, which means you got to pay me 3% a day. That's loan shark money. In fact, loan sharks are nicer than that. Not that I would know. Okay, so net cash. Let's just add all the cash-like stuff and then subtract all the cash-like stuff. So they have net cash of 54. Yeah, it could still be worth it if you know the stock is going to drop 50% next 2 weeks. Paying 3% a day. I mean, 3% a business day. It's a tough one. You better be sure. Okay, so this is interesting. I like this. This is a value stock. American Express. There's got to be a catch here because these numbers are like too good. Let me see last year's 10Q or 10K. Sorry. If you need to short quantum, just get a loan from your girl. And if she says no, man, just go hit up that purse. You got to know each purse, the Gucci, the Fendi, you got to know how to declare the Prada. Just take the cash out and go. You might call it unethical, but as long as you put the money back, right? As long as you put the money back. Just put the money back in time. That's what I'm saying. Yo, ain't nobody's girl here have a Hermes bag, bro. So you just put the money back, just slide that back in, you keep the profits. And then if that don't work, let's say that the trade somehow goes against you. Very unlikely event. It goes against you. Here's what you do. I got you. Go drink, get some malt licky, maybe hit the GG, whatever it is. Whatever you need to do to get lit, get turned. Okay? And then start smashing stuff across the house. Just start smashing everything. Just throwing stuff off the shelves like that. Right? And you leave and you come back and you see her standing there in disbelief. And you say, babe, what happened? And the whole place is a mess. And you say, yo, we got robbed. And she's like, oh my God. And you say, what'd they take? Check your purse. Say, God damn it, the money missing from my purse. You say, fuck. I hate these robbers. And your girlfriend says, you know, it seems like we always get robbed around the time the market goes up. Isn't that weird? Yeah, babe, it's crazy. That's plan one. We was robbed. There's several other ways to go about this. You need that emergency money for that stock that you took a little too big of a position in, and you need backup. Lots of ways to do it. Write it down. Another way is you tell your friend that you got $5,000 coming in next week, but you need the money now, and you're gonna lend him the $5,000 next week. Okay? So what you do is you go to another friend and you get the $5,000. You keep rinsing and repeating, and that is what Warren Buffett used to call float. Zero interest debt that you owe to the community. As long as you keep up them payments, you got the float. Somebody's always short 5,000 of your three friends, but they don't even know. They're lending it to each other, basically. You better hope that trade goes right. Otherwise, you're going to need a different scheme to go pay it off. Then that's when the second robbery happens. I'm just saying. I'm just going to try to be creative, Try to be creative. What else can you do? Plasma. Hit up the plasma bank. Pay good money for that plasma. Saying. Using that intelligent MicroStrategy leverage. Your whole body is a bank. Use it. Plasma. Red blood cells. Do a drug trial. That's another $1,500. Let's say you do the $1,500 on the drug trial. You're not supposed to be in 2 phase 1 drug trials at once. But let's say you do a phase 2 and a phase 1 at the same time. Maybe able to clear $2,000 off that. Do the plasma study next week. It's going to be challenging logistically. We didn't even talk about OnlyFans and Backpage yet. That's the whole other dimension. That's if you're really trying to level up. Usually, a lot of phase 1s are inpatient. But if you're doing multiple ascending dose versus single ascending dose, listen, you know how it works. Whatever it takes. Every share you get, every Satoshi you get is worth it. Every fart coin you can buy. Fart coin up 14%, 62.5 cents. Very much back to shortable territory here. In some way, sometimes short selling is better, sometimes puts are better. In general, I prefer short selling. Options should scare you generally. Yeah, you gotta just, the same thing like stocks. You just gotta choose your entries, choose your pain points, know the volatility. Look at the historical return histogram. Do a simple, you guys wanna see how to do that? Let's do it. Let's go fart coin, okay? Type fart in the terminal. I'm gonna zoom into the terminal so you see this. See that? Oh, look at that. I gotta take a photo of this. That is not, that should sort of look a little different. I personally don't like these little guys up here. I never use this feature. Okay. So anyway, you type fart and fartcoin pops up. You can hit enter at this point, or you can hit tab. I just hit tab, and you want the currency, and you do HP for historical prices. We may not have this for crypto. Oh, it's killing me. Well, let's pick a similarly crazy stock. Let's do Palantir. And then you do HP, and you get this listing. So we'll do that. We'll make sure that crypto has this. And we just hit download. And I want Excel, but for some of you programmers, you might want JSON. But let's just do Excel. All right, here's the Excel. By the way, Yahoo Finance will not let you do this for free, which is crazy. So here's the data. And here's the simple, you do 1 day change. Okay. And we just go down for the last year, it looks like. It's the default. Okay. And then we're just going to do mean. In Excel, it's average. Okay. Average. There's 4 key ones you got to look at. Average, standard deviation, min, and max. These are the 4 that I really like. Did they change standard deviation? They have population standard deviation and sample standard deviation. I'm going to use .sample. And you can see that the standard deviation is 4%. So naively, you would say I should be able to survive a 3 sigma attack. So 3 sigma, does anybody know what percentage 3 sigma occurrences are? You guys should know. .73. 1 sigma is 68%. 2 sigma is 95%. 3 sigma is 99.73. Okay? So you figure you should survive a 3 sigma event. Now, let's sort of see what the minimum maximum here is. I find it almost hard to believe that Palantir, the worst day for Palantir in the last year was down 15. And the best day was up 24. So you can already see that this isn't a normal distribution. You know, clearly not quite normal. So another way you could sort of do it is say, well, let's just take the worst day ever and double it. That's a pretty naive way to do it. But let's say I could see this stock go down 30%. That's possible. How many? We should also do sample size here. $248 occurrences. So if you multiply that by 99.73, you should expect roughly 2/3 of one event happening in that 3 sigma range, and that's sort of what happened. So it wasn't too far off from normal distribution, actually. So in any event, around 20 million, we call. So in any event, you do this, and you basically say, okay, whether it's 3 sigma or the worst event, or the worst event times 2, this can guide your position size, okay? So now you say, okay, max loss for me might be 5%. I cannot lose more than 5% of my portfolio. But your max loss might be higher. I'm okay losing 15% of my portfolio in one stock. That's a lot. Well, if this is the most it can go down, say 30% in one day, that the daily thing matters because you want to stop yourself out. So it also, by the way, if you're short this, you would use this max, which was a lot higher, up 24%. It's like theoretically it'd be possible for Palantir maybe to go up as much as 50% one day. Okay, so we're solving for what? For position size. And then we're really solving for position loss in a way. So we know what the max loss is, which is, in this case, down 30%. So how do we do the math here to figure out, well, what position when down 30% would result in a 15% loss to my portfolio? Well, there's a few ways to do this, but does anybody have a good idea? Well, you could do this really poorly. You could say, okay, well, if I had a 100% position, maybe that would work, but the smarter way to do it is divide, right? So it's 50% position. So if I have 50% position at a 30% position loss, that's kind of the most I should have on Palantir. And that's I want you to stop thinking about multiple times leverage or something like that. I'd rather you think about it as this is the position size, like that's it. It's not about, necessarily leverage. So a 50% position, according to your survival metric, right, which is 15%, a 50% position could survive or bear, it's at the periphery, it's at the boundary of surviving at a 30% loss. And your math says 30% loss is kind of the worst possible thing you can expect in a single day. But let's say you say I'm happy to have 50% loss. Well, in that case, you could actually have a leveraged position. You can have a 1.7x your whole portfolio in this stock and still sort of live to see another day. You have 95%. You can be 3x levered. So it's not that leverage is bad. It's just that you really have to understand it. And the problem is, as you can see, these assumptions are pretty much not. I was actually talking to my girlfriend about this last night. They're not always grounded in reality because the observance, the things you've observed have a certain distribution doesn't mean the next observation won't be out of whack, right? There's the famous turkey example where the turkey says every day the farmer comes in and feeds us. The next time the farmer comes in, he's going to feed us, but the next day is Thanksgiving. The farmer's not coming in to feed him. The farmer's coming in to do the opposite. So, you have to be pretty careful about that. One way you can look at it is you look at the actual limits and the bounds of what are the company's assets themselves. Are they diversified? Are they, are they a company with a single asset? And that could actually be a lot more informative than, say, VAR or whatever. all these things are sort of the same metric. We are functionally using VAR when you they're all sort of ultimately they're all a function of the same thing. Which is the prior experiences. And the prior experiences don't really tell you too much. So let's say we look at a stock that's a lot. Let's do this for Johnson & Johnson. It's not very volatile, is it? And it's a pretty diversified business. Can we think of an even more diversified business? Procter & Gamble. This is almost like an indestructible business, right? And I'm just going to take the values from this and paste them over. I wonder if that'll work. Let's see if that'll work. Yeah, it worked. Okay. Very different picture, right? Very different picture. The mean return on Procter & Gamble is literally 0% per day. The standard deviation is 1.1%. Massively different, right? What was it for the max for Palantir was what? 24%. The downside was what? -13 or -15. The standard deviation was what? Standard deviation. Positive 4.4, I think. And the average was something like 0.5% or something. Look at how different those are. Totally different complexions. You also have to account for, is the business I'm trading levered itself? Because if they're levered and you're levering it, then it's double exponential leverage in a way. Okay, so here you can kind of reason that your maximum one-day loss for Procter, really can't be more than 10%. It seems extremely unlikely it'd be more than 10%. You can go backwards in time and look. But if you say that, you're guarding against a 10% position, you could have a 5x levered position in your portfolio and live to tell another day. And the only way you'd really be nicked hard is if, you basically had a flash crash or some other nuclear bomb or something crazy happening. That's really the only risk you're bearing. Now, is it smart to go take a 5x leverage position? No, of course not. But the point is, if you're going to trade Procter & Gamble, you should roughly have, here's the best way to look at it. You should roughly have a 4x position. If you're going to trade Palantir, it should be 1/4 of the position as you would for a Procter. So that's kind of the way sort of sized up. So if you have 1,000 shares of Procter & Gamble, maybe you have 250 shares of Palantir. But if you have 1,000 shares or $1,000 of each, I should say, or $1 million of each, you basically are 4x overexposed to Palantir because it just swings so much. Now maybe you want that, but just know what you're getting, if that makes sense. Yeah, this is just looking at variance. Sometimes, the historical return histogram function, HRH, coming soon to Godel. VAR is definitely what one of the chat members mentioned. VAR, value at risk. There's a lot of techniques, but I would call it risk management. Risk management is the word. Yeah, I think you just, some companies have intrinsic diversification. J&J, Berkshire, Procter, etc. Some companies don't. Even Microsoft, really, really diverse, right? Sharp is a whole other metric typically designed for funds. You can use Sharp on stocks, but probably not the best way to do it. Kelly is a whole other can of worms. Yeah, you have to make your own assumptions on what you think the upper and lower bounds of risk are. So I highly recommend you do it. In fact, if you have a system like I have where you list every stock somewhere, whether it's this or it's in biotech, you can even put like on the side somewhere, like what is my upper bound or lower bound of risk? You know, and for NVIDIA, it's like really high risk. Whereas for Microsoft, it's a lot lower because NVIDIA has one product. It's an awesome product, but it's one product. And if something goes wrong where people don't want that product anymore, well, Microsoft can survive if people don't want Azure anymore. They used to not have Azure at all. You know, Google is largely one product. Meta is funny. They sort of have 3 or 4 products, but functionally the revenue comes from one product. So you have to make the call. What does that mean? How do I manage that? And you can always just err on the side of caution. Whew. Okay, so we're in the middle of looking at American Express. I wouldn't say there's a decisive factor. I mean, I'd say that we're just always looking for stocks that are wildly overvalued, especially if there's an element of kind of the sucker's bet, if you will. You know, we like to see the sucker kind of getting sheared, if you will, the sheep getting sheared. And, you know, but that's not always the case because, you know, just because the retail sucker is there, it doesn't mean that the institutional trader is a sucker or not there either. I'll be taking like probably a lunch break soon. I'll be gone at 4 o'clock. I got to bond with my teammates here. The homies are here. Whole bunch of guys who normally work remote, even though we tend to not do remote work. We have a couple of guys that do it, and I make them visit. They don't visit. That's a problem. This is so annoying because it looks like they restated or something. If you work remote for me, you got to come in at least once a month. Or it's like you don't even like. Again, I'll make exceptions for like the superstars, you know. This is so confusing. Interest income. Oh, here it is. User error. Yeah, they've really been shrinking the share count. They've gone from 790 to 713. Yeah, it's pretty obvious quantum is just a house of cards. And the people that think it's cool are pretty misinformed. But you know, that's the hypothesis at least. Okay, so it looks like cash flow for Amex bounces around a bit. Not 100% sure why, to be honest. It's a weird loan. I guess it comes and goes with loan growth or something. Don't short Palantir. At least don't short around the quarter. Okay, 2020. Okay, so here's the catch. In 2020, I knew there was a catch. In 2020, free cash flow is only $4 billion. Do you see this, chat? So I looked at these and I said, wow, that's a lot of cash flow. 13, 20, 17, 12. But here in 2020, cash flow is $4 billion. And so the enterprise value is $135 billion. So even still, it's super juicy. It's like 10x cash flow. But that four billion makes it not look so great. Yeah, I mean, I think timing's really hard. I'd say just define, you know, try to get the exact kind of right position, you know, in terms of what your size, you know, wants to be. So like if you see yourself constantly like timing it a little too early, then just lower your size and then add another slug at the top, quote unquote. I don't know. It's something that's unique to everyone. It's like a snowflake or fingerprint. Palantir is alpha, so you're getting negative alpha, I think. You're getting a whole boatload of beta. So if you like the Palantir short trade, short Palantir and buy SPY and see how that goes. It could be overvalued. It's probably overvalued. Because I wouldn't short it. SBC is normal. Every startup, every newish company does SBC and transitions down away from that. People won't work without options. Literally, that's what they're working for. That is their compensation. That's just totally normal. And you have to expense it using Black-Scholes, which the whole Black-Scholes thing is kind of bullshit in the first place. So I don't think there's much there. I would focus on the revenue. The revenue is really good. The second that revenue, slows down, then you can go ham. What did they do here? Marketing? What did I miss? I missed one. It's bizarre. Oh, okay. So they kind of lumped marketing in there before. Okay, once again, you know, huge share count decrease. They keep buying back stock. Buffett guiding the way there. I like this. The numbers are just too good. American Express, folks. Write that down. Wow. Yeah, the 2020 was an anomaly. That's it. I'm calling it Amex. Cheap. Buy Amex. Well, Chris, you know, you got to look at cash flow. They have cash flow. So if you're looking at revenue because you don't want to look at cash flow, or Palantir's real cash flow. Yeah, Amex is good money. Let's open Palantir up just because there's some discussion about it. You can open this up on my just from my GitHub. So last year, Palantir did 1.1 billion in cash flow. So just off the bat, you know, it's 180 times earnings, but cash flow is also about to more than double. So cash flow will likely be over 2 billion very soon. So, you know, it's not, yeah, it's expensive up here. There's no doubt about that. But, you know, it's not fair to look at revenue. I'd sort of try to figure out if they're going to have a slowdown. When the slowdown happens, that's when you would short it. Until then, I mean, there's probably a price where you'd short it anyway, but, you know, 100, 200 times earnings isn't that crazy for a company growing really fast. It's not a valuation where I'd be running to buy it either, but 40, 50% revenue growth is that's a huge amount of revenue growth. 36% revenue growth. So whatever they're doing something right. Again, you know, if you knew next quarter was going to be a little light, I mean, you'd short the crap out of it. But each quarter they've had big numbers. The growth of growth has to end. I agree with that. But what if it ends what if it ends at 40% and stays at 40%? That's now look, at a $1 trillion market cap, I would short it. But Jonas, yeah, it's almost like we've also been conditioned that they're going to keep beating. Look at that D-wave, not holding up too good. I'm cold. This office is cold. Okay, so when we get back, let's look at stock. We got